Investing in the stock market can seem like navigating a maze, especially for beginners. The sheer volume of information and the complexity of financial jargon can be overwhelming. Don't worry. Understanding key metrics like price-to-earnings ratio, PE ratio, and earnings per share, EPS, can make it much clearer. These metrics are essential tools that can help you cut through the noise and focus on what really matters. These tools are like financial detectives, helping you assess the worth of companies and make informed investment choices. By analyzing these metrics, you can get a better sense of a company's profitability and its potential for growth. Think of it like buying a used car. You wouldn't purchase the first one you see without checking its condition and price, right? You'd want to know if the car is reliable, if it has any hidden issues, and if it's worth the asking price. Similarly, PE ratio and EPS provide valuable insights into a company's financial health and help determine if its stock is a good deal. The PE ratio helps you understand how much investors are willing to pay for $1 of earnings, while EPS shows you how much profit a company makes per share of its stock. In the upcoming sections, we'll break down these concepts into simple terms, making it easier for you to understand and use them effectively. We'll explore how to calculate these metrics, what they indicate about a company's performance, and how to use them in your investment strategy. Let's unravel the mystery of PE ratio and EPS together. By the end of this journey, you'll be equipped with the knowledge to make smarter, more informed investment decisions. The PE ratio, or price-to-earnings ratio, is like a price tag for stocks, giving you a clear idea of how much you're paying for each rupee of a company's earnings. It's a crucial metric for investors. The PE ratio is calculated by dividing the current market price of a share by the company's earnings per share, often abbreviated as EPS. This simple formula helps investors gauge the relative value of a stock. Imagine Company A's share is priced at 100 rupees and its earnings per share, or EPS, are 10 rupees. This scenario is quite common in the stock market. The PE ratio in this case would be 10, calculated by dividing 100 rupees by 10 rupees. This straightforward calculation is fundamental in stock analysis. This means you are effectively paying 10 rupees for every rupee of Company A's earnings. Understanding this ratio helps in making informed investment decisions. A high PE ratio could indicate that investors are optimistic about the company's future growth potential and are willing to pay a premium for its stock. This often happens with companies that have strong growth prospects. Conversely, a low PE ratio might suggest that the company is undervalued or not expected to grow significantly. It could also indicate that the market has low confidence in the company's future performance. By comparing PE ratios across different companies and industries, investors can identify potential investment opportunities and make more strategic decisions. Earnings per share, EPS, tells you how much profit a company makes for each outstanding share of its stock. It's a crucial metric for investors to understand a company's profitability. It's like checking the engine power of a car before buying it. Just as you wouldn't buy a car without knowing its engine specs, you shouldn't invest in a company without knowing its EPS. To calculate EPS, you divide the company's net income, profit, by the total number of outstanding shares. This simple formula helps you gauge the company's financial health. For example, if Company B has a net income of 1 crore rupees and 10 lakh outstanding shares, its EPS would be 10 rupees, 1 crore rupees divided by 10 lakh shares. This means each share earns 10 rupees. A higher EPS generally indicates a more profitable company, which is usually more attractive to investors. It suggests that the company is generating more profit per share, making it a potentially better investment. However, it's important to compare EPS within the same industry, as different sectors have varying benchmarks. Always consider other financial metrics alongside EPS for a comprehensive analysis.